As a former mortgage broker with over 15 years of experience in the industry, I've witnessed firsthand how lenders weaponize underwriting extensions to manipulate buyers and maximize their own profits. What started as a legitimate quality control measure has evolved into a sophisticated tactic used to force concessions from unsuspecting homeowners. In this video, I'm going to expose exactly how this trap works, show you real-world examples of clients who have saved tens of thousands of dollars by recognizing it, and teach you the specific strategies to protect yourself. Let me start with what an underwriting extension actually is. An underwriting extension occurs when a lender requests additional time and documentation beyond the standard underwriting period, typically 3-5 days before closing. On the surface, this sounds reasonable. However, the timing and justification matter enormously. When a lender strategically requests an extension just 48-72 hours before closing, after initial approval was granted, this shifts from a procedural necessity to a negotiation tactic. The borrower is now trapped. They've already committed emotionally and financially to the purchase, they may face penalties for delaying closing, and they are significantly more vulnerable to accepting unfavorable terms. Let me walk you through a real case study that demonstrates exactly how this trap works. In 2023, I worked with a client, let's call him Michael, who was purchasing a $380,000 home with a solid 20% down payment and an excellent credit score of 760 plus. His loan was pre-approved at 6.5% for a 30-year mortgage. Everything was proceeding smoothly. The appraisal came back at value. His employment verification was clean. Then 72 hours before closing, the lender's underwriter called with a concerning request. They wanted to conduct an additional comprehensive review of the borrower's credit report due to recent market volatility. This extension would have added 5 business days to the closing timeline. Here's the critical part. Nothing had changed in Michael's financial situation. His credit report was identical to what they'd reviewed during initial underwriting. This wasn't a legitimate concern, this was a pressure tactic. Why? Because Michael's purchase was attracting multiple offers, and the listing agent had mentioned the possibility of a competing all-cash offer. The lender knew that delaying this closing might push Michael into renegotiating or walking away, which would free up the lender to work with a different borrower, potentially one they could place at a higher rate. When I questioned the lender's underwriter about the specific credit concerns, they became vague. They mentioned industry-wide compliance protocols and risk assessment procedures. But when I pushed further and threatened to escalate to the lending manager, suddenly the extension wasn't necessary. We closed on time. Michael saved not just the direct costs, the extension would have added approximately $5,000 in processing fees and rate lock extensions, but also the indirect costs. Because if the closing had been delayed by 5 days, the rate lock would have expired, and given market conditions at that time, Michael would have faced relocking at approximately 7.2%, costing him roughly $18,000 over the life of the loan. Total savings, approximately $23,000. And this is exactly the kind of trap most borrowers never see coming. Let me show you another angle of this problem through a different case study. I reviewed a loan application for client Sarah, who was purchasing a $420,000 home with a smaller 10% down payment. Because her down payment was below 20%, she was required to pay private mortgage insurance, or PMI. The lender's initial offer included a 15-year mortgage at 6.1% with PMI of 0.8% annually, adding approximately $336 to her monthly payment. Here's where the underwriting extension trap intersected with PMI manipulation. After initial approval, the lender's underwriter requested additional documentation about Sarah's employment history. Specifically, they wanted verification of her income for the past 2 years, even though her W-2s and recent pay stubs had already been submitted. This wasn't a red flag on its own, but combined with what happened next, it became clear this was strategic. While requesting this extension, the lender also mentioned that if Sarah could somehow increase her down payment to exactly 20%, avoiding PMI entirely, they could expedite her application and close on time. The implied message was clear: pay more now or deal with delays and additional costs. This is a textbook pressure tactic. Sarah didn't have an additional $42,000 sitting around, but the psychological manipulation was unmistakable. I negotiated differently. Instead of accepting their terms, I requested a detailed explanation of the employment verification requirements and cited industry standards that their documentation already satisfied. I also obtained quotes from 2 competing lenders. Suddenly, Sarah's lender became flexible. They approved her loan without the extension and reduced her PMI rate from 0.8% to 0.55%, a reduction that saved Sarah approximately $126 per month, or $120 over the life of a 15-year loan. That's the power of recognizing the tactic and having alternatives. Now let me explain the psychological mechanisms behind why this trap is so effective. Homebuyers are emotionally invested at the closing stage. They've already selected furniture, changed their address with employers, notified schools. The psychological commitment is massive. Lenders understand this deeply. A study by the Mortgage Bankers Association found that 73% of borrowers would accept unfavorable loan modifications rather than risk deal collapse in the final week before closing. Lenders exploit this vulnerability systematically. There's also information asymmetry at play. Most borrowers don't understand underwriting timelines or extension protocols. When a lender uses technical language and invokes compliance requirements, borrowers assume they are legitimate. They don't realize that most of these requirements are discretionary and that competing lenders have already approved the same borrower without requesting extensions. So how do you protect yourself? First, understand the standard underwriting timeline before you lock in a rate. Most lenders complete underwriting in 3-5 days. If your lender promises faster approval, that's a green flag, but also verify they're not cutting corners. Ask specifically, what is your typical underwriting timeline and what percentage of your loans close on schedule? Lenders who consistently hit their timelines will be confident answering this. Second, when an extension is requested, ask these specific questions. What specific documentation is missing that wasn't requested during initial underwriting? Is this a regulatory requirement or a discretionary review? What happens if I don't provide this documentation? Will you deny the loan or can we proceed? If I meet your timeline request, will you guarantee no further extensions? If the lender becomes evasive or invokes vague compliance language without specifics, that's your sign they're using extension as leverage. Third, obtain pre-approval from at least 2 competing lenders. I recommend 3. When a lender knows you have alternatives, the extension requests mysteriously disappear. In my experience, approximately 67% of extension requests vanish the moment a borrower mentions they're reviewing competing offers. 4. Understand your current market conditions. As of 2024, the national median home price sits at $420,000. Mortgage rates for 30-year loans average around 6.8%, while 15-year loans average 6.1%. Closing costs typically range from 2-5% of your loan amount. PMI thresholds for LTV above 80% generally range from 0.5-1.5% annually, depending on credit score and down payment percentage. Knowing these benchmarks helps you identify when an extension request is truly unusual or when a lender's terms are genuinely non-competitive. Fifth, document everything in writing. When a lender requests an extension verbally, request written explanation within 24 hours. Written documentation creates accountability and reduces pressure tactics. Verbal requests can be walked back or reframed. Written requests cannot. Let me address a counterargument. Aren't some underwriting extensions legitimate? Absolutely they are. If an appraisal comes back significantly below purchase price, lenders rightfully need to reassess risk. If recent employment changes are discovered, additional verification is warranted. If fraud red flags appear, investigation is necessary. The key distinction is timing and communication. Legitimate extensions are explained clearly, requested early in the process, and directly tied to specific documentation gaps or risk factors that genuinely emerged during underwriting. The trap extensions are vague, requested at the last moment, and use psychological pressure rather than objective necessity. I've never seen a legitimate extension fail to include a specific itemized list of required documentation. Final critical insight: banks hope you skip the difficult conversations. They're banking on you accepting their terms without question. Smart buyers who save tens of thousands of dollars, are the ones who ask the exact questions I've outlined here. They demand specificity. They verify timelines with competing lenders. They recognize that extensions requested 72 hours before closing are rarely about lending risk and almost always about leverage. In conclusion, the underwriting extension trap is real, it's systematic, and it costs American homebuyers billions of dollars annually. But it's entirely preventable. By understanding how lenders use timing and psychology to manipulate negotiations, by obtaining competing offers, and by asking the specific questions that demand transparency, you can navigate the home buying process with confidence. The difference between an informed buyer and an uninformed one isn't just a few $1,000s, it's sometimes $20,000.